Good afternoon, everybody. Welcome to our webcast on short verticals. I'm Connie Hill with Schwab Coaching, product manager, and happy to see each of you joining me here today. We have some folks that come very regularly, which I so appreciate. So just a quick hello to John, the Noble Savage, Paul, Life in the Fast Lane, Don, Sharon, Nirmal, and several others of you joining in here today. We are joined in the chat by Brent Morris, which I'm happy Brent is here. He's going to help me answer your questions. I'm going to keep an eye on the chat, so as those questions come in, I try to stay on top of them. But Brent will tackle some things that maybe I can't get to. All right, but we do want to answer your questions, so let us know. Now, do you suppose in our 40 minutes here together, more or less, that you could, in a measurable way, see time decay? You ever tried that? We're going to do that today. And if the market cooperates with what I want to do, then I think that it'll teach us some lessons about time decay. All right. Hope that you have already become a subscriber to our Trader Talks channel. If you haven't, there's a little logo in the bottom right of your screen. You can click on that. It will allow you, it looks like a YouTube logo in blue. It'll allow you to subscribe, but just do it once. If you do it a second time, it unsubscribes you. Okay, so just if you haven't done it before, go ahead and do that. Well, let's go through our disclosures and let's lay out our agenda for the day. Getting some responses from you here that some are saying, yeah, possibly so. We might be able to see time decay. We'll give it a go. Well, options carry a high level of risk and are not suitable for all investors. What we talk about today is for informational and educational purposes. Do not consider it a recommendation. Schwab does not recommend the use of technical analysis as your sole means of investment research. Investing involves risk, including the loss of principal. We will be using the Paper Money software application. That's what you download to your computer. It's the most robust version of thinkorswim. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. That is a little bit different in paper money than in the live market. In the live market, it will assign it early. In paper, it doesn't. Okay, so you don't get that actual experience there, so we want to make you aware of that. Past performance of any security or strategy does not guarantee future results or success. All right. I'm going to give a little nudge to you to attend one of our upcoming workshops or market drive events. We have going on in Scottsdale, Chicago, which is an advanced class, advanced options, and Detroit. These are fantastic events. People love them. If you've been to one of them before and you want to share your experience out in the chat, feel free to do so. Let others know what they might expect. We treat you good. We feed you. We kind of spoil you in a way. Okay, just telling you. All right. As far as our agenda today, we always want to talk about aspects of short verticals. Now, I hope that all of you have some understanding of what a short vertical is, given that this is an intermediate level class. But if there are some of you that are newer to short verticals, I surely want you to stay here and absorb what you can. And we'll try not to do anything too drastic to lose you. Okay, so we'll kind of talk about the short verticals here. Something that's important is our trade management techniques. You know, once we get a trade on, what do we do with it? Okay, we're going to talk about that. We're going to be looking at quite a few examples today. And as I mentioned in the intro, we are going to focus on time decay. All right, and what that means, what that looks like. So to begin with, we're going to go out to thinkorswim. We're going to go out to SPX. We're going to record some information. All right, so head on over there with me. And some of you might want to bring up your own thinkorswim. You don't have to, but if you wanted to, you could. Looks like we're still down a little bit in our market so far today. But what we're going to do is we're going to be using the index of SPX. All right, and let's get SPX back here. It is an index, okay? We cannot trade the index. There are some futures contracts that trade based on the index. But what we're going to look at here are some of the options. And I want you to, one thing you need to know is that when these options, because it's an index, when they settle, it's done in cash. there's no physical representation to give to you per se, right? If we're doing spreads with, say, a stock, Apple or something like that, well, it's the stock that we're working with as far as our possible settlement needing to take ownership or something of that nature. But SPX or other indexes, it's just cash settled, okay? And one thing that's kind of nice about this particular type of index is that it's what we're going to call European style, and European style options don't assign early. Wow, how cool is that? Not getting assigned early. Some of you've had that happen to you before. You're like, sweet, I don't even have to worry about that. And you don't. All right. Now, what we're looking at here are some options. And I'm going to point out something that some of you might know, some of you may not have noticed this before. There are some indexes, not many, but some that have very frequent expiration dates, okay? So you can see here on the SPX, we've got an expiration date, 0 days, 0 days, which means it expires in the morning because it says little AM there. That lets us know the settlement will be in the morning, not tonight, based on tonight's values. And then you can see them going on here every few days that there's an option for us to be able to track. Now, what we're going to do here is we're going to take an at the money option in this one that's 0 days to options expiration. Let's go ahead and open up that particular series. Right now, SPS is at 61.02, and so the closest option strike price is going to be 6,100. Okay, we're going to record that information. So right now, it's at 61, I'm going to say 02, 6102 point, let's get the point in there, 18. Get rid of that 5. Okay, the strike price that's at the money right now, we're going to record that. I might need a little bit more space here. So we're going to go with the 6,100 because I just want to do the at the money strike price. And then I want you to notice in the columns, I've got several columns here, so I might need to tell you what they are. We've got our delta, our open interest, our volume. This column here is important, extrinsic value. And this column right here is important, intrinsic value. And you'll remember, hopefully from your options training, that extrinsic value represents time value. Okay, so we're going to put in here our extrinsic value, which right now is at 4.41. And our intrinsic value, let's give us a little more space here, has $3.86. All right, we're recording the information, and we're going to come back and check on this little guy. Okay, we're going to check on it several different times throughout our webcast. And the number that you're going to be wanting to keep your eye on is the extrinsic value, 441. So it's this column right here, 441. All right. I'm going to do a little art for you. Now, I am not known as a great artist, okay? One of our producers can testify to that because she has seen a drawing that I did trying to replicate artwork that my sister did. She's really the artist in the family. But we're going to give it a try here. So I'm going to draw, just on our blank sheet of paper, a little graph here. And the bottom axis is going to be represented by time, okay? As we look at charts, right, they go out in time, they progress. This side of the axis is going to be called, I'm just going to call it premium, all right? And actually, no, we're not. We're going to just call it time value, okay? And it definitely has a number, all right? So we're just going to stick a little dollar sign there. And then we're going to talk about the time value in an option. And this is like one of the most important concepts for option traders to understand is what happens with time value, specifically for these short verticals. Now, this is where my artistic skills come into play. And I'm going to, oops, I blew it already. Okay, we're going to go with this lower line, okay? You get the general idea. Okay, ignore that little line up there. That's just a, we'll call that a hair. In any case, This represents what happens to time value as time goes on. When we have a lot of days before options expiration, okay, say for example, let's go with say 120 days. If we're 120 days out from options expiration, time decay is really minuscule, okay? Might even be lower than a penny per day, okay? So we'll just say 120 days. And maybe as it gets out here to say about 60 days before options expiration, man, the slope is steeper here and it decays more rapidly. And as we get nearer to options expiration date, man, it slides. Okay, so some people might liken it to an ice cube that you're holding in your hand. And that ice cube, you pull it out of the freezer fresh, it kind of contains itself for a long time before it starts to melt. But then as it melts, the body of it gets a little bit less. Now, obviously, we're going to have drippy water there, so there's still some volume. It's just the idea that over time, and not very long time with an ice cube, that ice cube or that time decays. All right, so that's your visual. That's my artwork for the day. And what we're going to observe is how much time decay we have in that SPX option. And it'll expire today. Now, we're not going to be able to stay with it until it expires, okay? So we have about a little over 2 hours, a little less than 2 hours that the market is open here, okay? But we're going to see some meaningful progress, noting that the option that we're taking notes on is right smack down there as far as running out of time. All right, let's go to our next thing. I do want to put some additional trades on for our class. We love to do example trades. Oops, let's get rid of those drawings. Those look ugly. There they go. And since we're here, we're on the SPX, let's just look for a moment. We did the 6,100 strike price and our extrinsic value, it started at 441. Now it's down to about $3, isn't it? Well, 287. That's the last number I saw flash in front of my face. All right. So we're just going to record that like this is a column of the extrinsic value. Now we're going to take a look at a stock. Market's a little bit down today. When markets are down, sometimes you might decide to take advantage of a stock that's struggling. Okay. You don't have to. Overall, we're in pretty bullish market conditions, okay? But we are going to do one little bearish trade on something that's just been showing us weakness, okay? Constellation Brands. My blue line is a 10-day exponential moving average. The red line is a 30-day simple moving average. And so we can kind of see what's been happening here on this 6-month chart. Yeah, it's really been struggling. It's, even though it's a staple stock and some of the staples are doing quite well, even if I zoom in here a little bit, we can see they disappointed on their earnings. Looks like this has been a support or resistance area here. Looks like it's running back up into that range of resistance. And looks like, because we've got a red candle, it's down a little bit today, that it might be continuing in weakness. Now, with a vertical trade, what we're trying to do is generate a credit that goes into our account. It comes in just as soon as we make the trade. Now, that's different than when we say buy an option. And when we buy an option, we pay for it up front, and then we're hoping it gains value, and then we sell it off, and that's when we collect profit on a trade. But in a credit spread situation, we're actually generating that credit up front. All right. John Noble Sages said, theta is time decay, correct, or is it Vega? Yeah, it's absolutely time. One way to remember that is that theta starts with a T and time starts with a T. And volatility starts with a V. And Vega, that measures volatility, changes in an options price due to volatility, starts with a V. That's kind of a little trick that some people have used to keep track of that. So very good. All right. Let's go. We've got our technical setup. Our implied volatility is a little bit high here. When stocks are downward trending, yeah, the volatility tends to be a little bit higher. Let's compare it, say, to a 1-year chart. And it kind of looks like as it's been dropping here, that implied volatility has been increasing. What does that mean for our options? For our options, it means that that they might be a little pricey, they might be a little juicy. Bring up Constellation here. And we can see Constellation isn't too bad, okay? We've got some weekly expirations, we've got a monthly expiration that I've got open here that we're going to use. And so it's about 30. So I would say it's kind of medium volatility, although right now it's kind of at a higher range than it has been during the course of the year. Okay, so as the price has been dropping a little bit, implied volatility has been rising a little bit. All right, now we're going to do here, we're going to put together a trade. Let's see if this still makes sense for us to do. When we're looking to put together a credit spread on something that's bearish, we use the calls, and we're going to sell an option here, and then we're going to buy a hedge leg. That hedge leg helps us define our risk in this trade. Now, just kind of a gauge that some people might do, they will use the delta to help guide them as to which strike price they want to sell. Sometimes we have lots of choices, and sometimes we don't have a ton of choices within that range. So a general range is maybe 20-something of a delta to maybe a low 40-something of a delta. And many people try to target somewhere in the 30 range or high 20 range if they're seeking a high probability trade. Now, the other column that you need to know is this column here. This is our probability of expiring out of the money. And on a credit spread, when we sell it and we bring in that premium, our hope is, our ideal expectation is that it will expire out of the money, right? We collect the premium and then we watch it decay, just like that ice cube. So as we look at our deltas here, we've got a 45, we've got a 31, and a 20. Now the 31 kind of is the sweet spot here. So we don't have a ton of choices with this one. So we're going to go with this 31 delta. And that looks like it's going to be selling our 180 strike price. And so we're going to say sell. Make sure this doesn't bounce around on me. Vertical. It's going to go grab that next strike price, which is just fine. It's $5 away, and a $5 wide spread is great. Now I'm going to go ahead and click on that and save that value from jumping around. Okay. And so from the get-go, at this point, somebody might say, well, I want to make sure it's giving me a good enough return. If it's not giving me a good enough return, I really don't care that it's at a 31 delta. Okay, I might want to choose something else. So we're going to bring in our little calculator here. We're going to collapse our scratch pad. And with a $5 wide spread, looks like, what is that going to be? Max loss is going to be 5 minus 117, which is going to give us 383. So we're going to take our max potential gain, which would be $1.17 or $117 per contract that we do. And so let's take our $1.17 and divide that by our 3.83, which is our theoretical max loss. That's going to give us about a 30% return. Now, some people, they find that completely acceptable. For our purposes today, for our class, our example trade, we're going to say that's great. We're going to use it. We've got lots of open interest contracts. We've got a little bit of volume here today. So yeah, we're not needing to make sure we only do a real small position because we don't have many contracts. That's one of the things I really am a stickler about. I want open interest, okay? Doesn't take you long to deal with a contract that does not have a lot of open interest, and you get burned and you realize, oh, okay, yeah, we want to make sure we're paying attention to those numbers, all right? So here, how many contracts can we do? In our notes, we can risk in our portfolio, we can risk up to $1,500. Okay, so let's see how many contracts we could do. So we have $1,500 divided by 383. That's what we'd have at risk per contract. That says we can do 3.9 contracts. Can't do partial contracts, so we're just going to stick with the 3. And we're going to put that in. Now this 117 times 3 contracts, it's going to come into our account immediately when we sell this. And then ideally, it shrinks and shrinks. So we're going to have to exercise a little bit of patience over the next 29 days. as hopefully that theta decays. And again, getting close to options expiration, it will increase the rate that it melts, the rate that it decays. So we're going to put in an order here to buy it back when we get a chunk of it. Now, you don't have to do this. Some people are of the mindset that they don't want to put an order to buy it back just yet. They want to kind of see how it goes. In our case, we typically put in an order that says if we get a chunk of 170 or 117, go ahead and buy us back. Okay, so let's go 117, our max theoretical gain, times, in this case, let's suppose 75%. Let's suppose we get 75% of the premium, only 25% is left. So I'll multiply 0.25 towards that 117, and we're going to go buy it back with 29 cents. So let's create an opposite order. Let's go ahead and put in here 29 cents. We're going to make it good till canceled. And then you don't have to try to capture it, right? You don't have to sit there and watch at your computer and see where it goes. If it moves there, great. Thinkorswim locks in that price for us. All right. We are going to put confirm and send. We're going to put this in our bearish short verticals bucket. We haven't really done a lot of bearish trades. And again, we pick on a loser with the expectation that it's going to keep losing. And we want to be filled on this. I'm in the wrong spot. Let's go to activity and positions. I didn't hear it go off. It looks like it's changed a little bit. We'll give it a little time. We'll look at another example. And then hopefully it'll come back up. If it doesn't, we'll have to come out here and change it. Okay. All right, let's take a short trip. Let's go to our SPX. Let's go check on our option. All right, we're coming back up to 0 days to expiration. Okay, so it expires today. Let's get rid of our calculator. We're looking at the 6,100 strike price on the call side. Here's our 6,100. And actually, looks like when we did the trade, or we started looking at it, was 6102. It's gone up to 6108. Well, what does that mean? Well, for the intrinsic value, you know, it's starting to go up because it's going beyond the strike price. The extrinsic value, let's see what it's worth right now. Let's get on our, make sure I'm on the right line item. All right, right here. Looks like it's down to 219. So it started at 441, 287. Now, let's type this in, exactly 2.20. Interesting. All right, let's go to our next trade. Let me make sure I've not missed any questions in here that I need to answer. Brent's helping me out, which I appreciate. Thank you, Brent. Let's see. Okay, I think we're in good shape. Let's carry on. Next trade up. This is kind of interesting. We're going to take a look at Palantir. Now, Palantir has been an upward trending stock, had fabulous earnings, right? It gapped up on earnings, and man, it's run really big. We know that. Ignore this little circle. That was on a trade that we did after earnings, okay? The bottom of the gap many times will act as support. What's it doing today? Yeah, it's testing out that support level. So it gapped down, came down, went even a little bit lower than the line, and it's running back up. You know, by the time we get to the end of the day, if it continues like it is, we don't know if it will, it looks like a reversal candle. It also looks like a stock sitting at support. Some people like to sell a credit spread when the stock is at support. They might not wait for it to give us a bounce, might not wait for us to have a hold. If they see something like this where it appears that it's bouncing off of support. Now, implied volatility on this stock is fairly high. If we go out here and look at a year, looks like I don't have a year. We'll go with 2 years. You can see there's regular intervals. It runs up. As soon as earnings announced, drops off. But right now, it's kind of in a little bit of a higher range. Okay, right now it's at 72. Low points would be maybe around, what have we got there, 0.37. Okay, so it's in a little bit of a higher range, absolutely not the highest. Okay, but it's got some decent implied volatility. Now let's bring up the option chain here. Palantir. All right, on this, let's do a short put vertical. We're going to do a bullish trade, and this is really neutral to bullish because we're going to expect Palantir to kind of stay up where it is. We want to sell a strike price. In this case, let's go back to our shorter range look. We want to maybe sell on the other side of support so that the support kind of acts as a little barrier to keep the stock away from that value. Okay, that it hits support, bounces up is the intent. Of course, never guaranteed. Okay, but remember our line here is about 99. Now we are going to use the March 21 options here as well. Yeah, we'll use the March 21 options. That will be fine. There could be some of you, if you want to scope out the weeklies, there might be some numbers that you're okay with. We'll see. Now here, we're going to come on the put side. We're going to go down the deltas, and we're going to see the possibilities here. Actually, I'm just going to cheat real quick and look here. Actually, that's the one. I didn't write down which month we were going to do, but this is the one we're going to do because I need to see the dollar increments. Okay. So we're going to come over here, look at our delta, look for a 20-something to 30-something delta. Now we have lots of choices here. Look at all these 20s. There's our high 20s. We're getting into some low 30s and then to 40. So we've got lots of possibilities here. Now we're going to go with one that I had eyed before our class. And let's see if it still looks like it would make sense. Okay, if it doesn't make sense, we won't do it. All right. I was looking at doing the 93 and buying the 91 as our hedge leg. All right, let's see if it gives us something similar to what I was seeing earlier. The stock has bounced up a little bit more than when I actually decided those strike prices. And so I'm going to say we need to ditch the strike price plan, find something that gives us a little bit more credit, because this is quite a bit out of the money, okay? Let's just shift here. Let's look at 95.93 if we say sell that vertical. 95, 94, 95, 93. All right. Looks like about a 46-cent credit. And that's in line. Okay, what delta is that? About 25. Is that below 99 where I had that line? Yeah, it's $4 below it, and looks like $9 below-ish, right, where the price of the stock is right now. So that gives us quite a bit of leeway. Probability of expiring out of the money starting at this point is about 70%. So that's higher probability. If this is not a good enough return for you, you might consider coming out here a little bit. Let's go to our calculator. And let's just see if we're at 0.45 is our max theoretical gain. Let's divide it by our max theoretical loss, $2 minus 0.45, which should give us $1.55. That's going to give us a 29% return. Now, some of you might be okay with that. Some of you might want a higher return. Some of you might want a higher probability. Okay. If you were to go further out of the money, you can see these probabilities inch up. If you come a little bit closer and want to have a better premium, right, a more healthy return, you know, you've got several here that are in the 60s, right? Once it crosses 60, we consider it high probability. For our purposes today, we're going to go with this, but I'm going to unlock this. Oh, good. It came up a little bit. All right. Oh, look at that. That was 49. I wonder if we could lock that in. Well, let's go figure out. I'll lock it there. Let's go figure out how many contracts we can do. Now our max loss is about 151. So if we take our $1,500 that we can risk, divide that by 151, that says we could do 9 contracts. So we're going to, all right, we're going to do our 9 contracts. We've got thousands in open interest, so it's not going to be a problem for us, right? And the spread is really quite narrow. 250 by 267, that's Yummy. That's delicious. We love to see stuff like that. We love to see that spread pretty tight. All right, so we've done 9 contracts. Let's go ahead and do an opposite order, and let's go buy it back when we get a chunk of this. All right. First one we did, if we get 75% of it. This one, let's say if we get 70%. Okay. So 0.49 times 0.3, because 30% is left after we've captured 70. That says go buy this back at 14 cents. I'm going to round it to 15. I just need 1 decimal there. And we're going to make this good till canceled. Again, we're not going to have to try to catch it. We're going to look for the system to, if it gets to that value, go ahead and create our trade, lock in the partial gain, and move on. We're done with our obligation. I'm going to put it here. We're going to put it in our bucket for the bullish short verticals, and we're going to send it on its way. All right. Frankie, let's see. Oh, Brenda's helping out Frankie. Okay, I think we're good here. Frankie was saying, hey, there's lots of volume if we go to the March 14s. Yeah, somebody could consider doing the March 14s as well. Yeah, look at this. Lots of open interest, lots of activity here today as well. Okay, this stock is one that has a lot of liquidity in it, which we love to see. All right, let's do this. We've got our 2 trades in, a bearish one, a bullish one, and let's go check on our SPX value. All right. Remember, I said we're going to watch time decay before our very eyeballs, okay, in a meaningful way. If we had chosen something way out in time, we would not be seeing the kind of decay that we're seeing, okay? If we had come out here and picked, say the April options with 55 days, we would not be seeing the rapid decay that we're seeing with something that's going to expire today. So let's go to our 6,100 strike price. And it looks like it now is at about $4.39 for intrinsic value, because now it's in the money. What's our extrinsic value? Oh, it's actually gone up from where it was. But did you notice what happened with the price? Looks like maybe the price pulled back a little bit. I'm thinking it was up here about 61.08 or something. Now it's at 61.04. And so our extrinsic value, maybe because of implied volatility, maybe because of the movement of the stock, it's a little bit higher than it was. Okay, so we're like, oh man, we watched it decay, and now it's not quite as decaying. If I was looking at the correct line, 3.64. Okay, we're going to put that in. We're going to go back. Now, we have a couple of trades that I want to spend some time with a follow-up. And then if we have time, we'll do one more trade. I've got a couple of things outlined for us. Now, monitoring your trade and making decisions is just such an important piece of the puzzle, all right, in terms of what we do. We can get in just like we're doing now, but it's kind of like, well, you know, how do we decide when we're wrong and so forth? Looks like we haven't been filled yet on our stars. Let's see, we started out at 117. Let's go get filled. We'll have to back off a dime or so, it looks like. We'll then do a cancel replace, bring in the current price. We'll still go for a midpoint, see if it will fill us at that midpoint price. Looks like it did. And on our stars, we wanted 49 cents. It's showing around 46. I really want to make sure we get in the trade. So let's do another cancel replace here. We'll go, just let it flood in, Connie. There we go. So about 45 cents now. We'll send that off because, again, we just want to get filled. All right. Let's come over to our position statement where we've got 2 trades that we're working on. First one, let's look at Affirm. Now, Affirm we got in last week. We've still got a whole month. Actually, both of these have 29 days before they expire. So we got a lot of time for the trade to work for us. So on a day maybe when the stock is moving opposite of the direction we want it to move, we don't necessarily need to freak out. Okay, let's look at the technicals on the chart. So on Affirm, Let's go ahead and type that in. Here is the day we got in, which was just last week in our class. We were seeing that it gapped up, kind of pulled back a little bit, giving it a nice little bounce. And it ran up for a couple days. And what's it doing today? Well, it kind of looks like it's testing this area that was resistance that now looks like it's going to act as support. That's what it looks like it's doing. I've got our strike price down here in the dotted line, that's 70. And with these short verticals, man, they can wiggle around, okay? They can go up, they can go down a little bit. And as long as we're not expiring below 70, we're in good shape. In fact, there could be times when the stock does go below 70. Maybe it comes down here a little bit and then runs back up. If we've got a lot of time before it expires, we might just be a little bit patient with it, right? Even though we think, oh man, this stock needs to go up, or we think it's going to go up, doesn't mean it's going to do it just exactly as we would like it to. You may have noticed that with some of your trades. They don't always do what you want them to do, but this gives us a luxury of just letting time work for us. Okay, so we're down on the trade a little bit. We would also look for something technical, okay? A break of support, maybe a significant break of support, not break of support by a penny, okay? Maybe if you notice a lower low, right? Say the stock is down here, maybe creating maybe a little, our previous low is actually going to be clear back there. It would have to come way down to make a lower low. But we would look for a technical issue with it. All right, not seeing it. So what we need to take a look at here is Shopify. And it's in the same boat. We got in it last week. We got in on this nice little close above the high of the low day here, all right? Ran up a couple of days, pulled back. What's it doing? Well, it's pulled back, and it's got this long shadow down here. We see the bears pushed it down, and now the bulls, as the day wears on, are pushing it back up. We are well above our short strike price here at 120, okay? So it's definitely above that. We're not concerned with it right now, okay? We're going to let it do its thing. Now, one that we need to look at was one that's already executed for us because we put our order in. All right. We got in. This one, I think I showed you at the end of class, and I said, I'm going to put this order in, but you didn't see me put the order in. Okay. But I went ahead, put it in, and we did on this one, we did a 34.36 short put vertical. We collected 60 cents. All right. And what did it do? Well, it did what we wanted it to do. Isn't it nice when a stock will do that? It did. And so it's been rallying up. What's it doing today? It's pulling back maybe a tiny bit, not a big deal. But what happened yesterday? Because we had our order sitting out there, it went ahead and filled for us. That's what the yellow circle means. And if we come over here to account statement, here's our stock we were working with. Here's where we put it in last week. We got a credit of 60 cents. And if I open up our order history, we'll see that we said, hey, if it can get to 18 cents, we get a big chunk of it, right? A big chunk of meat off the bone. We're going to get out of the trade. It submitted our order, and we got a little bit cheaper than what we would have, 16 cents instead of 18 cents times 10 contracts adds up, right? And so on this one, we ended up with knowing that what is this? We subtract 16 cents from 60 cents. Let's see what that works out to be. That works out to be what, $1.40? And so our $1.40 was our theoretical max loss. And if we do the math on that, I'll pull out the calculator here. Let's see. Max gain is 0.6, but we bought it back for a cheaper price, right? And so we ended up with a net of what is that? 0.44, right? 0.44. I think it's right. If I'm wrong, you let me know. And let's divide that by our theoretical max loss, which was $1.40. And so we came around with like a 30+% return on it. Okay. And so was it hard? Well, we didn't have to sit there and watch it, try to catch it because our order was in. So we could be out walking the dog or doing something else. Going to Brent's class, getting some good additional knowledge. Yeah, we could be doing a lot of things and not have to worry about it. Okay. So that is the update on our 3 trades. 2 are still working. This one moved for us pretty quickly. Now, in our remaining time, I would like to show you one more potential trade here. If we have time to do it, we will. If we don't have time, we'll just talk about what we might do here. Okay, Oklo. This is a stock that's been running up. Doesn't look like it has any earnings coming along the way anytime soon. But what's it done in the last few days? Yeah, it just really pulled back. Now, it has put in maybe a little bit lower low here, right? Because here was kind of a lower candle. Has put in a lower low. So some people might go, not so sure about it. But this is just on a 30-day moving average. Okay, it looks like maybe it's just kind of pulling back to support. Maybe it does the same thing it did back here in January, where it just kind of bounces off that moving average. Well, we see today the bears pushed it down to the bottom of that shadow and the bulls are pushing it back up. Now, it's not quite a hammer. Okay, a hammer would have a smaller head and a hammer would have a longer handle, which would mean the price would be up here a little bit more. And a hammer candle indicates reversal, potential reversal. Okay, so I said, let's put in a conditional order. It's not as high as I would really like it to be for a bullish entry, counting on that candlestick to do its job. It's just not quite there. But what if the price were to get to 43.40, which is about a little bit more than $1 away? Okay, we're going to put in a conditional order here. All right, we're going to go to, we're going to use the March options on this one. And we're going to go out to, let's see if this still makes sense here. Doing the 36, get the right stock. I've got to go fix my link so it starts flooding in off that chart. All right. I was actually eyeing, because look at this implied volatility. Super pricey. Okay, because this stock has been moving a lot. So we many times can go further out of the money with a lower delta because of the premium being inflated and juicy, ready to sell. All right, so let's do it here. Let's go. I had looked at 36.35. We'll see if this still makes sense. And we were just going to do a $1 wide spread. Okay. So in this one, it's a 25 delta. It's got 63% plus chance of expiring out of the money, which is what we want it to do. So higher probability. And it's a 25 delta. It has quite a bit of leeway from where the price of the stock is right now of 42. That's got $6. Okay. So that's a nice little margin. All right. My time is up, but what I'm going to do is I'm going to place this trade just like I did on the others. We're going to look for it if we get 70% of it, we're going to put in an order to go buy it back, get us out of the trade. Okay. So our 3 new trades are going to be Oklo, Palantir, and Constellation Brands, STZ. Remember that one was a bearish trade that we were looking at there. Now, what I want you to do is practice short verticals in your paper account. They don't have to be these exact trades, although if you do these exact trades, you can follow along, and maybe you've been looking at them during the week and have specific questions. So it allows you to kind of be a little bit more integrated into what we're doing here. Okay, so I'm going to challenge you, find 3 short verticals of any kind, okay, in your paper money account so you can learn these. You can only do so much standing on the sidelines. You really have to dive into the pool to get the manifestation of it all. Now, coming up next is going to be Kevin Horner with Getting Started with Stock Investing. If you are somebody newer to trading, that can be a fantastic class to go to. Kevin does such a great job with it. Okay. Now, I did not see any surveys out in the chat, so I think you're off the hook there. But if you found this helpful, go ahead and hit the plus signs or the plus button. Make sure you subscribe. Make sure you're following Brent and I on X. All right, we'll follow up on these trades next week. We'll see you with Kevin's class right at the top of the hour. Bye-bye.